Understanding DTI and income and their impact on home loans. Welcome back, viewers. Today we're diving into an important topic that relates to mortgage loans, DTI, or debt to income ratio. Understanding DTI is crucial if you're planning to apply for a mortgage or even if you're just curious about the lending process. So let's get started. What exactly is DTI? Well, DTI stands for debt to income ratio, and it's a financial term that lenders use to assess your ability to handle mortgage payments based on your income and existing debts. It's a key factor that plays a significant role in determining whether you qualify for a mortgage and how much you can borrow. Calculating your DTI is relatively simple. You divide your total monthly debt payments by your gross monthly income and multiply it by 100 to get a percentage. Let's break it down with an example. Imagine you have a monthly income of $5,000 and you have monthly debt payments of $1,500, which includes credit card bills, car loans, and student loan payments. To calculate your DTI, you will divide $1,500 by $5,000 and multiply by 100, giving you 30%. Now, let's discuss the significance of your DTI. Lenders typically look at your DTI to assess your financial health and evaluate your ability to manage mortgage payments. They prefer borrowers with a lower DTI, as it indicates a lower risk of defaulting on the loan. Generally, a DTI of 43 or lower is considered favorable, although some lenders or programs have their own guidelines. For example, though VA loans are restricted to 41% DTI, they will sometimes approve up to 50 to 55% DTI, depending on compensating factors. Keep in mind that your DTI is just one aspect lenders consider when approving your mortgage. They also evaluate your other factors, such as your credit score, employment history, down payment, term, and assets. But a high DTI can limit your borrowing capacity and potentially affect your chances to secure a loan. They want to ensure that you have enough income to comfortably cover your mortgage payments without being overwhelmed by other debts. To improve your chances of qualifying for a mortgage, you can work on lowering your DTI. One way to do this is by reducing your existing debts before applying for a loan. Paying off credit card balances, consolidating high-interest loans, or avoiding new debts can help lower your DTI and improve your financial profile. The two biggest negative factors that I regularly see are high card payments or student loan debt. Student loan debt is harder to get around even if you are in deferment. You will have an assigned monthly payment. Typically that would be 0.5 or 1% of the total loan balance depending on the program. The auto loan is a little easier to work around. For example, if there are less than 10 payments left, underwriting will not count that payment against you. You also can refinance your auto loan to a longer term, which may lower your payment. Even lowering your payment by $100 a month could approve you for another $20,000, give or take, depending on rate and term. The other thing people can do is pay off or sell their car if it's pushing your debt to income ratio too high. I, for one, would rather have an average car and a home than a brand new expensive car and be stuck renting. Another strategy is to increase your income. Consider taking on a side job or seeking a promotion at work to boost your monthly earnings. A higher income means your DTI will decrease, making you a more attractive borrower to lenders. A common question I get is, how long do I need to be in a job before I can use that income? The general answer is 2 years. However, if you are a W-2 employee, you have a much greater chance of getting approved with less than 2 years if you have a good reason and letter of explanation for the gap in employment. If you are self-employed, you need 2 years of tax returns filed. Remember, your DTI is a crucial factor in the mortgage loan process. By understanding it and taking steps to improve your DTI, you can enhance your chances of securing a mortgage and obtaining favorable loan terms. Where DTI gets tricky for some borrowers is when you are self-employed or large commission and bonuses. Typically, the way these income types are calculated is based off a 2-year average plus current year-to-date pay stub to show you are still tracking near those averages. With self-employment, this gets even more confusing because of potential write-offs and deductions. these files, it's best to work with a mortgage company that will pre-underwrite your income prior to giving you an approval letter. Believe it or not, most companies will not pre-underwrite, meaning the underwriter verifies your income prior to having an active loan, meaning there is an accepted real estate offer or are refinancing your home. If you want a very simple way to guess your income as self-employed, you can use a 2-year average of the net or adjusted gross income. This isn't 100% accurate because you may have more usable income underwriting can come back in, but it is a conservative way to look at your income as it removes the write-offs and deduction portions of your income. Staying on self-employed, if you find your debt-to-income ratio is too high, say over 45%, there are still options. Many mortgage brokers offer non-QM loans for self-employed borrowers. They have a different way of looking at your income. In these programs, they will go off your 12 to 24-month bank statements, personal or business, that shows your average monthly deposits. If you are self-employed and have a lot of write-offs, these programs will give you a much more positive DTI. These are just a few tips and things to consider when looking at your financial picture and how it relates to home loans. Working alongside a mortgage professional is highly recommended as they possess the expertise to guide you through various aspects and assist in identifying the ideal product and maximum approval amount. That's it for today's video. Please do me a favor and like and subscribe to my channel for more tips, tricks, and home lending knowledge. Feel free to reach out to me at dane@loanfox.com if you need a home loan, and if you have any suggestions for other topics, please leave them in the comment section below.